look at the bigger multifamily and say, I can do this?
And the goal is to get to 100 doors in the short term, kind of the next 5 years or so. If I can't, do that quicker.
Welcome. You're listening to the Apartment Investing Show. This is where you'll learn how to start or scale your apartment investing career. Your host, Adam Adams, set 6 school records in track and field when he was 14. Adam and his guests will show you how to create residual income by investing in apartment communities. Now, here's your host, Adam AAA Adams.
Welcome back to the Creative Real Estate Podcast. I'm your host, Adam Adams, the one and only. Actually, there's at least 3 Adam Adamses, all within real estate, which kind of surprises me. But recently, someone else posted on their Facebook one of the episodes with me, and this guy named Adam Adams reached out, and then this other guy named Adam Adams. So there's really 3 real Adam Adamses in real estate, just that I know of. So it's a small world. Today I'm with Nick Barlow, the Nick Barlow, unless there's more, I don't know. Well, welcome to the show, Nick.
20 on Facebook.
20 on Facebook. Perfect. More than maybe Adam Adams. You think?
I haven't searched your name on Facebook, to be honest. I already got your podcast, so I'd have to go check on that. But
got it.
One.
So it's good. This is going to be a really fun and interesting episode. It's a type of episode we don't always do, and so I'm excited to have Nick on here because there's a lot of podcasts that really only have people that have been involved for 20 years, or they have 100 million, blah blah blah. So we were thinking, someone who is in the middle of the journey. They've done a lot of really cool things. They're in the middle of the journey and they're ready to scale to the next level. So that's what we're going to be doing here with Nick Barlow, is just talking a little bit about how to go from, he has several rentals now, but how does he get from that to ultimately where he wants to go, which is to break into commercial multifamily. So we're going to be talking about some of this journey, how you can get from wherever you are to where Nick is, or if you are where Nick is, we're going to be talking about how you get to, where Rod Khleif and Joe Fairless and Michael Blanc are. So it's going to be a fun episode. Nick, why don't we start here? Just kind of, I know that you were in the military, you since quite a while. I know that you have a few different real estate rentals, some of them multifamily, perhaps some of them single family, and but the rest of the bio, I want you to kind of talk to the listener and share with them really the focus of this bio, the important parts to what's going to help them get to where they are to the next level. So if you could kind of give me a little bit more of the history that matters to that, and we'll get on to the show.
Yeah, so like you mentioned, I spent 7 years as an active duty Army officer. Grew up in Ohio, graduated in 2008, and then brings the end of 2015. Then transitioned to quote-unquote corporate life. Different speed between the two, and I started, I don't want to say getting bored, but started kind of doing some self-study on my own accord, and that's when I discovered real estate. My wife and I purchased our first triplex in October of 2017, and from then to now, we've grown to 5 rental properties, 13 doors. We have 1 single family, then a duplex, 2 triplexes. That second one we just closed on within the last 2 weeks of recording, and we also have a 4-plex. So it's taken a combination of, saving and then also using some creative uses of other people's money to get to this point today.
Nice. Well, I want to get into, just a bit of that history. You did mention that, you have 4-plexes and duplexes, 3-plexes and things like this, like all kind of spread out. Was it 13 doors?
Yeah,
13 doors. Okay. But you mentioned one thing that I thought was interesting, and this is the Creative Real Estate Podcast. You said you did some creative financing. What's one of the creative deals that you did in the beginning that helped you get to where you are?
In the beginning, it wasn't related to creativity. It was just saving money, having a down payment going, and buying a house. The creative one is really the most recent. That's what we closed on 2 weeks ago. So using the same lender, we cross-collateralized the debt on our fourplex to use as the down payment for the triplex. So the background on that is we bought the fourplex it was worth $130 when that's what we paid for it, and that was an under market deal essentially. We got it from a wholesaler, and in between the last year and now, we've had to replace the roof, replace a couple water heaters, done some other small tidying up. And we initially wanted to do a cash out refinance. We thought the value would appraise in the 165 range, and that's where it did when we got the reappraisal. I'm in the Midwest, so those are average prices for the Midwest. Folks in California probably like flipping out. That's so cheap. But that being said, when we did reappraise, we suddenly had a pretty large amount of equity, and our lender said, well, rather than doing a cash out refinance, you can just collateralize. So that's ended up what we had done. So when we closed 2 weeks ago, no money down. We actually left with a check because we had, half a month's rent from the one unit that's currently filled. We had taxes from 2019, because we pay in arrears here in Indiana. So we had that, and we also had a security deposit that we got as credits. But since there was no, cash expenditure because of the cross collateralization, we literally left closing with, those things to cover expenses, going forward. So that's the creative story under my belt.
That's cool. I like that. Well, let's start here. What is your ultimate goal?
Ultimately, the goal is to get to 100 doors, at least in the short term, kind of the next 5 years or so. If I can't, do that quicker, gain financial independence, and then from there, really scale to get into probably 500 to 600 door range, and really turn this into, essentially, the side hustle into the full-time income source. And as we go along the way, be able to start giving back and do education, have more time to do charitable events locally, and those kinds of things.
Okay, so to get to that 100 and ultimately 500 doors, is your plan to syndicate them or buy them on your own? Do creative stuff? What are you kind of looking at? Where do you want to go that way?
In the short term, we're looking at just doing syndication. Finding other folks that are like-minded. Finding the deal, pulling it together, and turning that into success. And that's how I think we'll get to 100. How we're going to get to 500 is a really good question, and I have a couple doors to go before I have to solve that problem. So I haven't really thought beyond the next 100-ish doors, to be honest with you.
Okay, got it. So in the beginning of this episode, I'm going to have you just ask me a couple of questions that you think might help you get from where you are with your 13 doors to your 100 or 500 door, and see if there's anything that I can add value to you in case someone else is listening and they have, around 13 doors, and that's their goal too. So why don't we start there? Do you have a question or two that you can ask right now on camera, and will hopefully help a lot of other people?
The first thing I'd like to ask is, do you have or I should say, how strictly do you adhere to a profit per door margin? And I ask that because when I think of that fourplex, typically like $100 per door is kind of like the bare minimum people kind of quote. And I came in a little under that in the first place, but when I kind of look back, obviously it's, raise rents a little bit over time, have a couple of expenses, and now I've been able to cross-collateralize that. And had I not done the deal, I wouldn't be, able to have done the next deal. So, how strict do you stick to those profit per door margins, and why?
Okay. The profit per door is a number that my team doesn't look at as much with the commercial stuff. So I can do the math and I can say, we've got an $11 million property that we're about to close. We're working on right now. And basically what that boils down to is if it's a 7% cap rate, then we're looking at it earning $770,000, basically 7% of the value. Another way to do it is to take $770,000 and divide it by the the NOI. So if you do that and you divide it by the 12 months that it takes, and then you divide that by the number of doors that we have, it averages around net profit is going to average around $236, I think. So I suppose one of the parts of the answers to your question is what kind of profit per door is my team looking at? And so one way to answer that is, I suppose others are very similar to this $200, $300 per door. It's not the only thing that we look at, though. In addition to that, I want to make sure that the rent amount per door is a certain number. And what we have found is that you must purchase properties with at least $700 in rent. And you don't want to go much higher than $1,100 in rent. So your real sweet spot is between $700 and $1,100 per month per unit. And the reason why that's such an important number is, number one, it's going to help you find the right tenant, the right resident, the person who's going to be paying the rent every month. And what they have found is if your rental amount is under that 700, like you did mention the Midwest, and I actually have some properties that I've recently sold and that I'm working to sell now that are in the Midwest, and the rental price per door was closer to 500. And that really helps me solidify all of this research that others have done. It's difficult to be able to get to net profit 200 per door if the amount is 500. So you first got to look at the sweet spot. Properties in the Midwest that had the 500 per door are definitely my hardest properties. So I was looking at cap rate. I was looking at things like price per door. I was looking at this other metrics that people buy, that is the 1% rule. So I was actually trying to do a 3% rule. So like I bought this is a long time ago. I just sold this actually and lost a ton of money. I heard that the 1% rule was good, that the 2% rule was even better. And so I was trying to find a 3% rule. I actually purchased a property in St. Louis in a pretty terrible neighborhood. I had people look at it for me, and nobody mentioned, that the market itself wasn't very good, but it was this was a fourplex. I don't know if I said 4 or 5, but this was a fourplex, and it was bringing in $550 per door. $550. So $2,200 gross per month. And if you take the $2,200 and multiply it by 12, that's $26,400. I was able to purchase that property at $55,000. So basically, just in 2 years, I would be able to pay for the whole property, right? In 2 years. So I got a mortgage on it. And later on, one of the tenants moved out, and it was very difficult to get that unit to be filled again and staying stagnant. And then I forgot to say that the property manager gave us a bid that we needed to put in $7,000 to turn it. So immediately wrote the check, $7,000, turned the unit. And then another tenant moved out, and I told my assistant, I said, do not give them another $7,000 until they fill that. She didn't listen. She cared more about making them done so they could both get filled. And the issue was that she didn't listen, and now we put another $7,000 to turn that unit. This happens slowly over a couple of years. And a couple of the morals of the story are, if the listener listens to us make the mistake of only talking about the profit per door, or only make the mistake of talking about the 1%, 2%, or 3% rule, if the listener hears us talk that the main thing is just numbers, what will happen is they'll make a mistake like many that have gone before that have bought place where the real ultimate metrics are not there. So I guess I want to say first that it's not as simple as just the profit per door. But to answer the other part of your question, as far as how much you should be making per door, I feel also that people miss a lot of the parts when they're buying maybe a single family house or something like that. And let's just go and talk about a normal single family house that would be, let's just call it $100,000. So that's nothing like my neighborhood. The single family houses here are like 600,000. And also, I know Youngstown, Ohio, the single family houses are 5 or 15 or 20 or 25 or 30,000. If I could just try to find a middle ground of $100,000, what's going to happen is people are going to say, I'm paying 100. The rent is, let's just call it 1,000. Well, that is good because so far that's fitting within my, that's fitting the 1% rule, because the 1% of the annual rent is the purchase price. So that hits the 1% rule, 1,000 per month and 100,000 purchase price. It's also hitting the right metrics of you should be above 700 and below 1,100. So you're right in that sweet spot also. So that's all good. And then that person will say that my mortgage is going to be, I think it'd be like $750 or something. I hope that's accurate. I'm estimating. So they'll say like the mortgage is $750, the PITI, principal, interest, taxes, and insurance. PITI, $750. And this happens a lot. So I've hosted over 300 different meetups, and at every meetup that I host, I have conversations with the people that are there, and it feels like most of them would say that their cash flow was $250. Does that make sense so far, Nick? Have you heard people say the rent is 1,000, the PITI is $750, so I'm netting, quote, I'm netting $250. Have you heard that before?
Yeah, I've heard people, kind of speak to that, and I think if you really do a lot of research, you'll find that there are other expenses you should account for. And I think that's where you're going with your conversation.
Yeah. So I first want to at least debunk the thought that 1% automatically makes sense, because sometimes it won't. And I want to debunk that the 700, 1,100 always makes sense, because sometimes it might not. So the way that I do my mathematical calculations for just about every property that I buy, and it always starts because I got into larger multifamily, and this number is always right around the 50% mark is the expenses, is the actual expenses, and that's going to come with your maintenance, your lawn maintenance, your snow removal, depending on where you live, right? Your tree trimming, it's going to come with the sprinklers. It's going to come with, if you're the owner and you have to pay the water bill, a lot of times, sometimes the owner will have to pay electricity or other things like that. Additionally, I think it was you that just mentioned that you had to redo a roof recently.
Yep, I had to replace a roof on a fourplex in September that I purchased in May.
Okay, so how much did that cost, like, to do your roof there? And typically, that would be anywhere from, for a fourplex, in my mind, $12,000 to $20,000 normally. What was yours? Yeah,
ours was right at $10,000. It was like $9,980 $2 or something like that.
Okay. So I know it's market specific. Like I think that it costs a lot more to do a roof in Denver than it might in Ohio or something like that, Indiana. So sometimes it'll change, but 12 to 20 is what I was thinking. You said you got it for 10 grand. I think that's awesome. Good job. And that's going to last you several years. Hopefully that'll last you 20 years, but it just depends, right? When do I have to do this again? When does the furnace have to be done again? If the tenant moves out, I'm going to have to skip rent for that month. How often am I going to have a tenant stay? A lot of people, they count in for vacancies. They count in for maybe 10 or 15% of the rent automatically for vacancies. So like if you have 1,000 a month, they might be saying 850 is what I'm really netting because of the vacancy. Automatically, I have to cut out the 10 or 15%. So when I cut out the maintenance, the capital expenditures like the roof, the tenant turnover, like how it cost me $7,000 to turn over one unit that was only $550. So it actually cost me more than a whole year's of income for that one unit, right? So once you start counting all of these things in, it's generally half of whatever you spent, whatever you're getting is going back into the property. So if I do that math, and I would say that $750 is my mortgage. I would also say $500 is my expenses. So I would, in this case, be around a negative 250 instead of a positive 250. So all in all, if you really want to dive into that, I would say if you can do the math like this, half of it all has to go somewhere else. Then I pay my mortgage and my principal and interest. And I want to still be able to net at least $100. If you could do that, I think you're doing a screaming deal. There's not a lot of places that you can buy for full price to do that right now. And I think that it matters more for you that are listening to say, does that mean I need to get a discount for something in a good area, or does that mean I need to pay full price in a bad area? I would rather suggest that you get a discount in a good area because the more problems happen on the properties that are C and D class. Like that fourplex that I told you about, that was a D. That was a D class, right? So it doesn't mean you're going to find a D class, but you want to be able to look for the better areas and just get the discounts where you can make that. So that's what I would suggest is always cash flow. And I'd say $100 per door is fine, except that I want you to cut out the right amount of expenses in the beginning. So that was a long-winded answer to your question, but I hope that it helps like anyone who's listening who really wants to get into that. We don't always look at that because we're buying more of the commercial. So just the exact per door thing is less than perhaps like the overall cap rate, the debt service coverage ratio, and things like that. So do you have any other questions that you want to ask? And I promise not to get long-winded on the next one.
Yeah, so for folks who are in my shoes, kind of mid-journey, they want to bust in the commercial space. And, in my situation, I live in a small town, population's 14,000, probably a 3-hour drive from 3 or 4 significant metropolitan centers, Chicago, Indianapolis, Columbus, and to name a couple. I want to get into those markets. And building relationships with brokers, you can't just go to a meetup that's 3 hours away on a consistent basis, when you're working full time, have family, kid responsibilities, that type of thing. So what's in your mind, what's the best way to really build those relationships over the long term to even get access to some of these markets?
Okay. For those people who are listening and they want to do what you want to do, that's to get into larger multifamily, bigger commercial deals. They need like you said, they need to have relationships and they need to have knowledge. What's the best route for them to go would be, I would give them 5 steps. I would give them five hard steps. The first step is going to be your mindset. I want for you to first, before you worry about having the relationships and everything like that, I want you to at least wrap your head around the asset class, the bigger asset class, and say, I can do this, right? Look at the bigger multifamily and say, I can do this. But you just got to ask yourself, how can you? Like, what is the way for you to do this? So first step, you got to know that you can do it. You got to feel comfortable. You got to be approaching it, looking forward to it. And you don't need to have you don't need to do baby steps. You don't need to go single family, duplex, fourplex, eightplex. You can, in fact, I went straight to multifamily. I never owned a single family before I owned an apartment. So you can do that too. So that's step 1, mindset. Step 2 is going to be just the free and very low cost education. So podcasts like this, continue to learn what other people have done, get some ideas. One thing that's going to do for you is going to start to help you have the right language. You got to speak the language, because when you start going into talking with those potential partners, you want to be able to have the right lingo. So step 2, after your mindset's wrapped around it, you're going to get no and low cost education. Step 3 is you're going to get high cost education. Basically hire a mentor, partner with somebody. I know I do it. Joe Fairless does it. Michael Blanc does it. Rod Cleave does it. I could name a lot of mentors out there. So you're going to want to, now that your mindset's where you want to go, now that you've started to speak the language, now that you know what's going on, don't jump into paying for that mentor right away. First, do the no and low cost stuff. Then the third step is hire a mentor. You need somebody in your corner to make sure that you're not going to make any mistakes. They will also help put you in touch with the right people. That's step 3. Step 4 is to start aligning with the team. Now, this could be align with a team that's already there, or start creating your own team. Now, I built my team from scratch. So in the beginning, it was more of like the blind leading the blind. So when I started to syndicate, I had done multifamily for like 15 years at the time. And when I started to syndicate, in the very beginning, nobody on my team had syndicated. And so we built it from scratch. And it worked, but I recommend what I think is better and stronger for you is to align with a team that's already there. And you mentioned that you've been to a couple of events. Your wife was just at an event last week, right? So this is the best way for you to start finding those people, start meeting them. This podcast, I know for sure that now that you're on here, you're going to get people calling you right away, being like, "Hey, I want to align with you. You've already done 13 doors, etc." Be cautious about the blind leading the blind. If you haven't done it all the way and they haven't done it all the way, be cautious of it, be conscious of it, think about it. If you could partner with somebody, there's 8 ways to partner in the syndications, okay? 8 ways. So this is still within step 3, aligning with a team or creating your own team. There's 8 ways that you can get involved. And I hope I remember them all. I didn't prepare for this ahead of time, but one is being a money raiser, raising equity, being an investor liaison, okay? One of the ways is basically by bringing the equity. That's a very valuable piece. Another way is to bring the deal. A team like mine, we need deals. We need good deals. If you found a good deal, you're automatically on the team. We'll raise all the money for you. We'll do all the other pieces, right? So the third way, so find the money, find the deal, would be to underwrite the deal. If you spent time underwriting, if that was your strength, if you're really good at underwriting, this could be a great way for you to get on a team and add value to people that are already doing it, so it isn't the blind leading the blind. Another way would be if you are a passive investor. So this is a good way to actually partner. I don't know if you knew this, but a passive investor is an equity partner. That means they own part of the deal. If the deal makes a lot of money, they make even more money. So you could be a passive investor. That's a really good way. A property manager, fifth way, manage the property. You can add value to a team by putting systems in place and managing the property. We have a market research team. All they do is they're forward thinking, and they look for areas that have the 700 rent to the 1100 rent, that C areas and B areas, no D areas. You could do market research. There's a few other ways. I won't dive into them, but I do have podcast episodes on it. If you want to scroll back to around episode 280-ish, you'll see that I have the 8 ways to get involved in a multifamily, and that can help you answer that question for yourself. Which one are you? I already named 5 ways, and there's 3 more that if you go to around 280, episode 280-ish, you should be able to find that. The 4th way, after you've aligned with a team or created your own team, now you have to take massive action. You've hired a coach. You're mentally set, you've listened to podcasts, you've networked, and you've started to align with a team or create your own team. It's time for you to take absolute massive action. And the biggest part that's going to hold you back is your fear. It's like you're going to feel so scared to buy your first 100. That's why you want to have the right team, the right mentor in place, because that's going to help you to be able to make that decision. I've seen a lot of people go from number 1 or 2 to number 4 or 5, and they've lost money. They didn't have a mentor in their corner. They didn't have the right team they didn't have the right people on the team, and they've lost money. So if you follow that 5 steps, I know that you'll be able to make the money. So if you want a tip for networking, ask more questions. If you want a tip for like when you're at a conference or a boot camp, what a lot of people do is they just tell their story automatic. But if you find a way to bring out the other person's story, you're going to build stronger relationships. It's really interesting when we use our 2 ears and 1 mouth in that order, how effective it can be. So I hope that helps kind of see where you're going. Don't skip the mentor part, by the way. That's a part where people see that it's a cost, and they feel like they're going to that it's a waste or something like that. Bigger Pockets often talks about how you shouldn't have a mentor. I've seen too many people that are on Bigger Pockets day in and day out end up losing money because they buy into that. I'm not selling my own services. I'm just saying if you don't have a mentor in your corner, it's going to be really hard for you to make money by going into these larger assets. I think it's really important. Nick, let's get talking about you. Is that okay?
Yeah, absolutely.
Okay, we're going to take a quick break and we'll be right. Say again?
I'm sorry to interrupt and say thank you for the input and the feedback. That's really great to hear.
Absolutely. Okay, so we're going to take a real quick break and we'll be right back with me asking Nick some questions.
This episode was made possible by Adam's Inner Circle program. This exclusive group is a collection of industry leaders, influencers, passive investors, and strong operators. This is the type of community you want to join, where we come together multiple times each month, virtually and in person. We support each other, invest with each other, and even interview each other on our podcasts, and invite each other to speak at our live events. If you're ready to take your real estate investing to the next level, this is the group for you. Fill out an application today by following the link in the show notes.
And we're back with Nick Barlow. I promised you we were going to get into some of his superpower. And one thing that Nick has learned over the last 13 doors that he's done is how essential, how important doing the proper market research is. And so I'm going to turn it over to you, Nick. What happened? What can you share with the audience that's going to help them stay out of a sticky situation?
I'm going to paraphrase here, but real estate's not just local, it's hyper-local. And one of the things that I can look at, my own experience that is, so I have a duplex that's about 7 minutes drive away from essentially the core area where we invest in our small town. And if you look at like drive time, it's about the same to all the major employers between our small city and the other smaller suburb out there. But the duplex out in the smaller suburb, I just have a hard time keeping it rented. I don't find the same quality tenants there as I do, in the more urban type of area. And the experience we've had is essentially, I didn't realize real estate was as hyper local as it is. I assumed the market research as close as I was would just kind of cover the area, and I'm not experiencing that, to be honest. A little rough out there.
Okay. Well, what is the way for the listener to, now that they're hearing that it could go wrong, what's the strategy for them, or I guess what are you implementing in your business now with this hyper local market research? Well,
I'm not investing in anything that's not in a real urban area anymore. So when I talk about going to the bigger markets I like to go to, like Indianapolis, Columbus, etc., everything I currently it's in the portfolio isn't even in cities that large. In my hometown, it's a population of 14,000. I'm doing fine there. It's the suburb that's those proverbial like two county roads intersecting. There's a couple of houses, even though it's only 7 minutes away from a decent sized city. So that's kind of I don't think it's a house specific issue. I think it's more based on the location, and because of that, I'm done investing in locations like that and looking for bigger urban areas.
Okay. So do you have any properties that you're under contract on right now, or you're kind of looking at right now that we could talk a little bit about?
I honestly don't. We just closed on this last triplex 2 weeks ago, and right now we're focused on getting it renovated, getting it rehabbed, and then also kind of dealing with other duplexes we spoke about. So at this point, we're a small mom and pop operation. I work full time. I traveled last week. I'm traveling next week. My wife's stay-at-home mother. She takes care of the kids, and then does much of the real estate stuff in between as we can. So at this point, we don't have anything that's like definitely on the list. Our next steps are trying to partner with some folks that she met with at the Rod Cleese Real Estate Conference last weekend, and really try to attack the Columbus market. We have a couple of folks we've met through various ways that are out there, and now it's time to really focus and hone in on building those relationships so we can start some type of deal flow in that market.
Awesome. Well, I think this will be super valuable to anyone listening. You work full time, and you have kids, right? You have like two kids? How many kids again?
Yeah, 2 kids. They're a boy and a girl, 6 and 7.
6 and 7. Not far apart. So,
nope.
But you've been able to purchase 13 units in how long has it taken you to purchase 13 units?
So the first purchase was October of 2017, and then the last one was 2 weeks ago here in January 2020. So
okay, so you basically
years is when
you basically had a 4-year-old and a 5-year-old when you were buying your first one, right? Full-time job, 4-year-old, 5-year-old, and now you have a 6 and a 7-year-old, and you've bought 13. Let me ask you this question that I ask a lot of my audience members. Where were you 5 years ago? Like before you got into real estate, what were you doing? What were you worried about? What websites were you looking at? Were you thinking about real estate? Just take me back 5 years ago and tell me what that looked like.
So 5 years ago, I was still in the U.S. Army. That was the last full calendar year of service. At that particular time, I was actually in Africa in my very supportive Operation United Assistance, which the mission to contain Ebola virus disease. Real estate was not on the radar whatsoever. We lived on post on the installation, so we were essentially renting. In terms of investments, I was really focused on doing investment purchases, DRIP, with stocks that pay dividends, consistently with blue chips. So that's kind of where the overall investment criteria was. We were maxing out both of our IRAs at the time, and being able to do that for a couple of years, going off a little market growth. It was just kind of where the seed money came from when we transitioned to real estate. But totally different life than I'm living now.
Yeah, thank you so much for going into that. I do have one last question. Well, penultimate question. After this, I'm going to ask how people can find you, because I know there's people that want to do that. So the second to the last question, what advice do you have for the beginner real estate investor? They're wanting to get in. What do you have for them?
Once you've done analysis, just get out and go do it. The amount of confidence that you get when you're able to go out and do, at first you hear the word entrepreneur and you're like, wow, is that me? But then you go out and you do it and you start, you get a deal or two under your belt and do analysis, and you get the confidence in your systems, get the confidence in yourself and in the industry, and then it's just like, go forth and do it. I think that's the best advice to give.
Go forth and do it. And you said the amount of confidence that it gives you after you complete your first real estate transaction. I know that one of the other multifamily people, a good friend of mine, Michael, he always says it's the law of the first deal. And, he and Rod Cleef, I'm a big advocate to just go straight into 100 units. Like, that's just me. But Michael and Rod, they both say, if what it takes for you is to get like a fourplex or a duplex, then do that, because like they said, the law of the first deal, what will happen to you by feeling that confidence after you say to yourself, I did close a multifamily. It might have been a duplex, but I'm a multifamily investor now, So I love that. Thank you so much. So they've got to take action. They've got to know the feeling that they're going to get on the other side of that success. So how do people find you? Nick, what's the number one best way? I know you're not huge on Facebook, as you mentioned a couple of times. I'm huge on Facebook, but what do people need to do to be able to reach you if they want to connect?
Yeah, I'd say I'm the most active on Bigger Pockets at Nick Barlow. I mean, you have the info there for the show notes and everything. So I think that's where I'm the most active. Part of this is I need to get more active on Facebook, and I'll try to do better there. And I'm also on LinkedIn, but that's also kind of from like the professional side and not necessarily the investing side. So any of those various ways, I speak the English language. I'm more happy to meet and speak and respond to anyone that reaches out to me.
Awesome. So if you are on Bigger Pockets, then why don't you go ahead and search right now for Nick Barlow and connect with him and tell him that you heard his story on the Creative Real Estate Podcast and you want to connect. You want to see if you could do a deal together. Maybe you want to be a passive investor in his next deal, whatever. So jump on to BP. I call it BP, Bigger Pockets. Connect with Nick Barlow and let him know you heard about him right here on the podcast, that his story was inspiring. And that's the reason why you're going to the next level, is because of Nick Barlow. I'm sure that'll make his day. Nick, thanks for coming on the show. I'm grateful for you being willing to hop on, show where you've come over the last 5 and 3 years, show what you are doing now, closing your fourplex, replacing the roof, doing your threeplex. Thank you for your service in the Army. We all appreciate that very, very much. And I love to hear the update right here on this podcast when you accomplish that 100 units at the end of the year. So once that happens, I want to talk to you again. I want to have you again on the show again. But for the listener, jump on to BP, find Nick Barlow. His contact info is also in the show notes. I'm going to let you go, brother. But until next time, think outside the box. As a reminder, any investment opportunities mentioned on this show are for accredited investors only. And if you're interested in working with me and my team, then go to realbluespruce.com and click Get on the List. It's that simple. Just click Get on the List to start passively investing. This has been an episode of the Apartment Investing Show with me, Adam Adams. All rights are reserved. And if you haven't done so already, then make sure that you absolutely smash that subscribe button, and I'll see you on the next episode.